When borrowing money, loans typically fall into two categories: secured loans and unsecured loans. The difference lies in whether you provide collateral, an asset that the lender can take if you don't repay the loan. What is a secured loan? A secured loan is backed by collateral, which can be a physical asset like a house, car, or savings account. The collateral reduces the lender's risk, often leading to lower interest rates and higher borrowing limits. Examples of secured loans: mortgage, your house serves as collateral. Auto loan, the car you buy secures the loan. Secured personal loan, savings or investments may act as collateral. Pros of secured loans: lower interest rates, higher borrowing amounts, easier approval for borrowers with lower credit scores. Cons of secured loans: risk of losing your asset if you default, requires ownership of valuable collateral. What is an unsecured loan? An unsecured loan doesn't require collateral. Approval is based on your creditworthiness, income, and financial history. Since there's no asset to back the loan, lenders face higher risk and typically charge higher interest rates. Examples of unsecured loans: personal loans, funds for various purposes like medical bills or vacations. Credit cards, short-term loans for purchases. Student loans, borrowed for education without collateral. Pros of unsecured loans: no risk of losing assets, faster approval process, no need to own valuable collateral. Cons of unsecured loans: higher interest rates, lower borrowing limits. Approval depends heavily on credit score. Key differences between secured and unsecured loans. Feature: secured loan, unsecured loan. Collateral required, not required. Interest rate lower, higher. Borrowing limit higher, lower. Risk to borrower: asset seizure. If default occurs, no asset risk. Approval easier with collateral, depends on creditworthiness. Real-life example. Secured loan example. You take out a $200,000 mortgage for a house. If you fail to make payments, the lender can repossess the property. Unsecured loan example. You borrow $10,000 for a wedding through a personal loan. If you default, the lender cannot seize any assets, but may report the default to credit bureaus, damaging your credit score. Quick recap. Secured loan, backed by collateral, offering lower interest rates and higher limits, but risking asset loss. Unsecured loan, no collateral required, with faster approval but higher interest rates and stricter credit requirements. Which to choose? Secured loans are better for large, long-term needs, like a house, while unsecured loans are ideal for smaller, short-term expenses. Understanding these differences helps you make smarter borrowing decisions based on your financial situation and needs.